Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber, I'm a financial advisor, and this video is not financial advice. What I want to talk about in this video is how in the world can you possibly justify GameStop trading at $21 per share? Right now, a $9.38 billion market cap for a company that right now has 9.44 billion in cash and Bitcoin. How can you possibly justify it? The easy answer, of course, is it's stock manipulation, right? It's just evidence of continued short sellers, naked shares, right? Rehypothecation, FTDs, ETFs, swaps, all of the above. And that's probably true. But if we looked at it from a fundamental perspective, is there a way? Is there a way to make this case, to make this argument that GameStop's only worth 9.38 billion? Another way I could say it is if you had to come up with a fair value of 9.38 billion, what does that mean? If you had to argue that from a fundamental case, what therefore are you arguing? I want to break it down for you guys in this video. Before I get into it, thank you to all the subscribers, the commenters, the viewers, the engagement. I appreciate it so much. We're on a march to 2525, aka the Halo Sub Club. Would love for you to join it. If you haven't already joined the Y2K Sub Club, which is now closed, okay? You're 180 subs too late for that. But you have about 300 something subs of space left to be a part of the Halo Sub Club. Would love for you to be part of it. Hoping to cross it before the end of the year. Also, thank you to those who join the channel as fans and as friends. I appreciate it. And all the earnings do go to DRS Booked Genie shares. About probably 8 days away from receiving October's income, and we'll see how many shares we can lock up together once that income comes in. Okay, so GameStop. You guys know, I think the fair value, if you were to aggregate by weighted probability, the floor case, the fair case, and the fly case of both the asset management business together with the retail business, you end up with a worst case valuation of $26 billion, or a best case right now in terms of fundamental support, which if the fundamentals continue executing, right, the ceiling would go higher. But right now you could justify even a $211 billion valuation, or for a weighted average 92 billion, which you could say is $208 per share. Or if you wanted to fully dilute the shares, you would call that $143 per share on a weighted average fair value. So how do you end up a seventh of that, right? Let's talk about it because first off, what you have to do is negate anything that is forward looking. Okay, so if you are a fair value analyst, then of course you are projecting future earnings and giving some type of discount to those future earnings, right? Some type of probability that those earnings will happen, right? And then you're doing some type of DCF on that, or you're taking historical earnings and going from there and basically saying we're not going to project growth. We're just going to wait until it happens, until we know that it happens, right? So you basically have to close your eyes to the Switch, close your eyes to the coming consoles from Xbox and PS or PlayStation, and then close your eyes to PSA and close your eyes to the comments Ryan Cohen's made about collectibles being about a third of total sales for the full calendar year. Basically, anything that hasn't already happened, you just blot it out of your mind. That's the first thing you really have to do is let's only go with what we already know for sure. Okay, that's step one. The next step is you have to net out all of the convertibles as if they are being paid back in debt and as if GameStop has to pay back that debt right now. And again, ignoring any future earnings that they make from the business and any future earnings that they make from the current cash that they hold. So if y'all watched a recent video I made talking about GameStop's cash floor, we know that even if GameStop pays back all of its convertibles in cash and they don't dilute, they will still, at no point on a per share basis, have a cash floor lower than its current cash floor of $20.62, which almost got tested today. Almost got tested today. Incredible. I don't mean that this cash floor can't be, I'm not trying to say that there's no way the shares could ever trade lower than that. I'm saying if you're valuing it fundamentally, you would say, hey, the cash value, the cash floor of this company is $20.62. And whatever it trades above that is what you would call the enterprise value, which right now the enterprise value of GameStop, the asset management business, plus GameStop, the retailer, hypothetically is $150 million. But if we ignore all of this cash generation, right? Forget all the cash generation, and we decide to net out all of the debt that will be paid back in 5 years, and net out all the debt that will be paid back in 7 years. And again, ignore any of the income that comes during that 5 and 7 year window. Then you get a net cash floor, right? Ignoring the future, what we already know they earned, right? So this 220 doesn't exist. Just going off of historical already reported numbers, you end up with a net cash floor. So, also netting out the difference between current assets and current liabilities, right? So, let's say we don't value the book of the business. I mean, there's not much book there, anyways, right? 1.1 billion in operating assets and liabilities versus a 29 plus 174 versus 1.0 billion in operating liabilities. Let's say you don't value those that $100 million of book value. All you value is the cash portion of the book value. You end up with 5 billion and 76 million dollars worth of cash, right? If you make all of those assumptions in cash. So that means the rest of the company you are saying is worth the difference, right? If you blot out the future and if you fully net out the convertible debt, then you end up with, okay, right now they have $5 billion worth in cash. So if you take that out of, let's just go with that 9.38 market cap, you end up with 9038 minus B40, an enterprise value of $3.9 billion dollars. Now, what does a enterprise value of 3.9 billion mean for GameStop? Again, just historically, because again, if we look in the future, you're talking about a company that is on pace to be cranking out $1 billion of net income on a forward 12-month basis. But if we want to look historically on their income, what you could do if you wanted to be hyper bearish is say, as it relates to their interest income, right? All of their gains on just cash and Bitcoin, what you could say is not only are we not going to project the coming interest and gains that will in all likelihood be generated, right? We're not only are we refusing to value the future interest, we also are refusing to place any type of multiple or enterprise value on the historical interest. What does that mean? It means that as it relates to net income, you would say the only thing we care about is operating income. We are not going to value any dollars of enterprise on interest generation, whether you're looking historical or you're looking future. All we care about as it relates to interest and cash is the present, right now, most reported number, and we're going to fully net out the debt that will, in all likelihood, be diluted, right? But we're going to act like it has to be paid out now. So you end up with 3.9 billion in enterprise value based off of just operating income. And if you only wanted to look at operating income on a trailing 12-month basis, you've got 55.6 million between Q2 and Q1, and then another 46.4 million between Q3 and Q4 of last year for around $102 million. Sorry, I keep going to the valuation tab. $102 million of trailing 12-month operating income. Okay, so if you didn't project anything, you only valued the historical 12 months, then what type of PE does that give you? B41 divided by B43. You're looking at a 38.8 price to earnings ratio on this $3.9 billion enterprise value. So is that rational? All those assumptions that I just made? No, but let's make a couple iterations to get slightly closer to rational, but still very bearish. Again, simply to highlight how could you possibly value this company the way that it's currently being valued? How could GameStop possibly be a $9.38 billion company? The other thing I want to highlight as it relates to this enterprise value that we haven't even talked about, if you want to get more bearish, is again fully pricing in the future dilutions. So if you know, and again, let's leave the warrants out of it. So let's say they're never able to convert the warrants into cash, but we know that 1.5 billion and 2.7 billion are going to dilute, right? So what do you do in the most bearish case? You basically you take the worst of both worlds with the convertibles, right? You assume it's all debt and it all has to be paid back today. You net that out from the cash 100% right now. And then you also assume that it's all going to dilute. And again, you net that out today, right? Forget about time value of money. Again, forget about all the earnings that are going to come between now and then. You fully dilute it right now. And um, as a result, discount the valuation of the shares proportionally. So a $3.9 billion enterprise value that will be diluted by about 200 million, or sorry, if it's just the convertibles, about 150 million shares, right? That 591.5 um, minus the 447.2 divided by the 447.2, that is a 32% dilution that's coming in 5 and 7 years combined from the convertibles. So if you price in a 32% dilution from Convertibles, you could say that, oops, you could say that the current um, enterprise value is already pricing in that dilution 100% right now. What does that mean? That means that basically you would take the current enterprise value, netting out the cash that nets out the convertibles as if they're debt, and then you fully dilute it or show the diluted impact of, again, those convertibles if they are paid back through shares. So worst of both worlds, a 32% premium gives you a $5.2 billion valuation based on 9.38 billion right now. So again, if you fully, so hopefully y'all are tracking. And what does that mean? You still would take the same trailing 12-month operating income, but you would end up with an even higher PE, B43 divided by B44. You end up with a 51 PE based on diluted equivalent price. So when you fully factor in dilution, that means that what you're saying is GameStop right now is trading at the same dollar per share that it's going to trade at even after those dilutions happen. And what happens when the dilutions happen is shares are created, right? So if you create 50 million shares in 5 years, and then you create another 120 million shares or 100 million shares in 7 years, but the share price doesn't change at all, what would happen is technically overnight the company becomes worth that many billions of dollars more, right? Dollars per share times shares in the float. So what happens in the short term is that the enterprise value can look artificially low, right, at 3.9, because you could argue that, well, basically they're already pricing in 100% of dilution, which if the price stayed at 2105 after dilutions happen, that would mean that assuming the cash doesn't change, right? That would mean that the 3.9 actually is like a 5.2 billion dollar valuation for the enterprise. So hopefully you guys are seeing how if you wanted to be as bearish as possible and blind yourself to what's happening with the company, a 38 PE on a non-diluted basis or a 51 PE on a diluted basis is not that's not a low PE, right? I mean, retailers, if you're at 20 to 25, you're at industry average. If you're at 30 to 35, you're considered an outperformer. And if you're above 40, you're considered a very fast grower, right? If you're in that 40 to even 55 range from a PE basis. So you could say that actually GameStop's growth, if you wanted to be very bearish on how you interpret the convertibles and refuse to forward look on their earnings generation from a interest income perspective and refuse to forward look on their earnings from an operating perspective, then you could say actually, once you net out all of those things, their growth is actually being respected pretty fairly. And again, historically, they are growing pretty impressively. Like their operating income improvement year over year, right? $88 million improvement year over year in Q2, $40 million improvement year over year, $25 million improvement year over year in Q4 after a little bit more of a dip at the beginning of 2024. So their operating income is improving and growing, and you see that 24% to 79% to 401% improvement, which is about to explode even higher, but hasn't yet, right? That gets reported in 4 weeks. It hasn't been reported yet. We can project it pretty accurately, but if you want to be super conservative with your investments, then you would say, I'm not going to assume anything at all about power packs just based on an interview from Ryan Cohen. I'm not going to take that CEO at his word. I'm going to look at the SEC filing, right? I'm going to see the actual numbers. I'm not going to assume they're getting a 10% margin on power packs. It might be 5% for all I know. They might be taking a loss on some of these cards for all I know to try to scale revenue, right? So it's as far as what assumptions here are the fairest or the least fair, if you want to think about it like that. I think it is fair. I think it's too conservative, but fair to wait until these Q3 numbers come in before factoring these Q3 numbers into your sales growth, into your cash floor, etc. That is fair, particularly because this is a brand new business. PowerPacks there's no data historically that we can go off of, right? So to say I don't want to value PowerPacks at all, I'd say that's maybe a little bit over conservative, but not like unfair, not like this is evil and suppressive. And then as it relates to hardware, you know that the Switch 2 is going to sell, right? So to include hardware numbers from Q3 and Q4 as if those are the accurate way to project their operating income, I'd say again is a little bit overly conservative and less fair than saying I don't want to factor in the Power Packs income and I don't want to factor in the uh, the income that we generated, right? The margins and the cash from that in that quarter. All that to say, if you were to do this exercise again in a slightly more balanced way, but still very bearish, the other conversation you have to get at is the convertibles, right? Do you fully price in dilution and fully price in debt? Both? You know it can't be both, right? Like worst case, it's either one of them or the other, right? It can't be both, right? And so if you did it as one or the other, which I'd say is much more representative um, of reality, even the biggest bear would say, yeah, well, it's definitely not going to be both. We just don't know which one it's going to be. Okay, well, let's run both side by side and see which one offers a like which one offers the lower fair value for GameStop, right? So in this one, we'll fully value GameStop's cash, not the future cash that we'll know of in a month, but the current cash, right? So we're going to we're still not going to value the rest of their book, but we are going to value all of their cash. You end up with basically a 9237 level for cash if these shares dilute. If you value GameStop's cash, then already they are trading below cash. Okay? Which again has happened before. Okay? Back when Ryan Cohen bought into the company, their market cap, net of their book value, was negative $431 million. Okay, so we are saying we don't care about the book value from your assets um, like your operating assets. We're not going to value that at all. But even if we just valued the cash portion of your book value, we're saying that the enterprise is worth negative $200 million. But then we're not doing dilution, right? So dilution's not, or no, sorry, we are doing dilution, right? Because we're valuing the cash. So take out the non-dilutive PE. Enterprise value factoring, yeah, I guess it's hard to say it's going to be worth even more negative once it dilutes. But I guess technically, is that technically what you're saying? What are you saying? If you value an enterprise at negative 200, then no, you'd expect a 32% improvement from that. So how do we take like the absolute value of like I want this to go in the right direction. That that difference here. Okay, so what if we did B 49 plus the absolute value of this? Okay, no, minus the absolute value of that. No. Absolute value. Okay, perfect, perfect. Plus B 49. No. Why not? Oh, because that's getting absoluted also. Just like that. Plus B 49. Jeez. That $64 improvement is what I want to show to the negative 199. Perfect. Okay. So then you're saying once you factor in dilution, this minus 199 is actually minus 135. The trailing 12 month, I don't know how you could get any more bearish than taking the trailing 12, right? I don't know how you could get any more bearish than that, particularly when it is growing, right? So then you end up with a PE of negative 1.32. When is it fair to value a company at a negative enterprise value? I mean, basically, you have to assume they are headed towards bankruptcy. They're imminently bankrupt. And when you consider the growth that they're seeing in operating income and net income, I mean, it's just impossible to make the case that this company is going bankrupt. It's just like I don't think I think this is off the table to value, which is just crazy. Because this is reality right here. Like the reality is these shares will dilute, right? And the reality is that if you factor in dilution, even if you fully priced it in today, they are still trading at negative dollars, right? You are getting paid to buy this business, which is just crazy. But as it relates to the hyper bearish scenario, I would say um, the hyper bearish but slightly more conservative. Let's try what if they don't dilute, but what if we net out all of the debt? So basically, you end up with the same cash, same enterprise value, but then you just take out dilution, right? And so you end up with a PE of 38. That seems to be the more plausible bear case, I guess you could say. And let's look at how plausible it really is. how plausible is it really? So I'd say the netting out all of the cash, I think is foolish when if you want to net out the future debt, then like if you want to pull forward the future debt, then I think you should pull forward the future interest at the very least, even if you didn't want to pull forward the income from operations. Like let's just say the business is a huge wild card. There's no way to know, right? If you wanted to pull forward this debt, I'd say you should at least pull forward the interest income. And even if you thought interest rates were going to plummet, right? I mean, what is the sum of this expected interest over that period? C34. Oh, you're not going to tell me because I put the plus signs there? Okay, fine. There's a billion right there. 1.8, 1.9, 2.6, 2.8. So there's 2.8 billion that's going to be generated in cash. If you wanted to say, well, there's no way to know, then okay, fine, you want to call it 2 billion, 1.4 billion, right? I think the point is to fully net out the future debt repayment without at least compensating for some of the interest income cash, right? Even if you don't think Bitcoin's going to do anything, right? I'd say at least put in some of this cash that will be generated before that debt payment is coming back. And I'd say if you wanted to be as conservative as possible, I'd say cut that in half, right? Call it a 1.4, right? Or just call it a 1. I mean, what's a number that's low enough that even the biggest bear would say, yeah, there's no way that by the time these are due, that the cash doesn't generate at least that, right? Which if you're going all the way down to 1 billion and you're assuming Bitcoin, let's say Bitcoin cuts in half or in two-thirds, or let's say it goes away completely, right? And then interest rates go all the way down to 2% on a weighted average basis over this 5-year span. So that means by 5 years, you think it's down at 0 or 1% if it's going to average 2% over that whole period of time. Right? I think 1 billion is very, very, very conservative as far as what cash is going to be generated before this debt has to be paid back. And again, the debt is 0% interest debt. So there's no interest expense that we're talking about here. I think that would be, again, too conservative for my blood, but fine, fair. You only want to assume they're going to generate 1 billion in cash over the next 7 years. Then operating income, again, to just not value this at all is just, it's shocking to me. But let's just say right now you wanted to call this a 2.9 billion dollar enterprise, assuming they only make a billion from cash. Now, at a 2.9 billion, it's not being priced for bankruptcy. So you're not valuing this income that's coming, right? You're not projecting this growth to continue. You're not valuing any of these net incomes ahead, but you are respecting the legitimate health of GameStop's business in this case, right? You're not, it's not a negative value. Okay, so you're not declaring imminent bankruptcy. GameStop price at 2105 does not mean, like, to justify that fundamentally, you don't have to argue that GameStop's going bankrupt. Okay, you don't. You like so far, what you can say is, hey, I'm gonna assume it generates at least a billion in cash. And then again, you have to argue, of course, that you're not going to give any premium whatsoever to the net asset value, which I think is insane. I think that's hyper bearish. to refuse to give any premium multiple whatsoever to a company, to an asset management company that would be the largest SPAC ever, right? Even if it's only $6 billion, or even if it's only $5 billion, even 5 billion would be the largest SPAC ever. It's crazy. So to not give any value to that, I think is crazy, particularly with Cohen's name, Cohen's track record, the growing institutional percentage, right? The track record to be able to raise capital, the track record to allocate investments that generate returns, the record DRS percentage. I think it's totally rational to assume some type of premium. But if you want to be super bearish, you say, I'm not going to give any premium to the cash. I'm only valuing cash one to one. I'm not a SPAC investor. I'm a deep value investor, right? Okay, fine. Cash is one to one. The other, so to call fair value cash right now at a six, or if you like somewhere between a six and a $6.5 billion threshold, in other words, to assume the minimum that they earn from their cash position before dilution or before the debt has to be paid back, the minimum that they earn is 1 to 1.5 billion. I think is um like not insane, not criminal. B50. Oh, no, no, no. I need to take this number and take out both of these numbers. Boom. Okay. And to say with high clarity what you know interest rates are going to do, or a high clarity what you know Bitcoin going to do, of course, is a little foolish. Like they could drop very sharply, right? So, but I think a billion as a minimum floor is fair. Then you're just talking about, so again, in the barest of bear cases, to say I'm going to give GameStop a $6 billion value on their cash, fair. Like again, if you want to argue with me on whether you think it's a good investment or not, or whether you think it's wise to be that bearish on this company or not, that's a different conversation. But I'm just saying, can you fundamentally get to a place where GameStop is actually only worth $9.3 billion despite having 9.4 billion in the bank? These are the conversations you have to have. And then the trailing 12-month operating income is the only other factor, right? So to call it an enterprise value of 2.9, you're just saying what is 9.3 minus however you value their current cash. And to say you value their current cash net of their debt, net of the minimum of what you expect that cash to generate is pretty reasonable. So the only other question is it reasonable? And I'd say, based on this picture right now, is it reasonable to give GameStop a 29 PE, right? A slight premium to what other retailers get, but not a lot of premium. Is that fair? Sure. I mean, that's fair. It's not crazy. It's not crazy. Is it fair to use the trailing 12-month operating income? Sure. So again, right now, is this fair? Okay, fine. But what about in 1 month, right? What happens in 1 month when the next numbers come out? What does that do for the cash level? Well, the cash goes up by about $200 million. Okay. And then what happens to the trailing 12 month? The trailing 12-month operating income, because that's all we're looking for is operating income. Basically, you add in 142 and you drop off negative 33.8, right? So after they report earnings in a month, their trailing 12-month operating income becomes minus 10.8 here, plus the 79.8 here. It becomes $277.6 million dollars. Literally a $175 million swing in trailing 12-month operating income. So again, if you want to argue that this price is fair right now because you're only looking at historical, okay, well, what does that mean? What does that imply when history keeps historying? You know, the future is about to become the past, baby. And once the future becomes the past, just one quarter out, okay? Just one quarter out. What does that do? You add in you take out a $33 million loss and you add in a $142 million gain to operating income for a net change, a net swing of $175 million hairs to 77.6. And what does that do to the PE? Right? If you say in 1 month they're going to report $200 million more in cash, you're still going to net out all the debt. They're going to report a $175 improvement in trailing 12-month operating income. Their PE immediately plummets by 67%, right? And then, okay, so basically the question becomes, all right, fine. GameStop's hypothetically, from a bearish perspective, fairly valued at 9.38 billion. Okay, but if they're still at $21 in a month, is that then fair? Right? Is a 9.9 PE reasonable for a business that then will have just reported another sequential explosive improvement in operating income and in net income and in cash and another quarter of declining SG&A? And once you have clarity, at least from a starting place of the type of volume that Power Pack sales is doing, the type of margins that they're commanding, what that means for operating income. No, if anything, the fair multiple goes from a modest 25, 30, 35 to, oh man, this really needs to be valued in the 40s or 50s if it really is growing like this, right? So not only does your cash increase, which then the same market cap would represent an even lower enterprise value, but the trailing 12-month increases, which means you're valuing it at even a lower PE, but the trailing 12 months is increasing faster each quarter, right? So the growth needs to be valued more substantially, right? So you go from a 29 would be fair, hypothetically, to it really needs to be more like 40. So in just a quarter, even from this bearish angle, you could argue that GameStop's market cap should at least quadruple, right? I mean, what type of enterprise value do you need for the PE to then be closer to 40? I don't know. What do you need? Oh, sorry. 15 billion, 14 billion, 12 billion. So 12 billion plus cash. So you're looking at like a market cap, a fair market cap in 1 month. If you're bearish of 18 billion, aka a 100% growth from this current level. So pretty exciting. And then again, you can do that same exercise one more quarter out. And what happens one more quarter out? Well, we'll model it in coming videos. So give me a subscribe if you've learned a single freaking thing out here. But another holiday quarter, right? We're looking at revenue that might be over $500 million in addition to their quarter three revenue. right? Almost a 20, like almost a 30% improvement, more than almost 40%. What, what is this? 19 minus 1345, 555 divided by 1345, a 41% improvement in net sales. Does that mean that operating income improves proportionally? They might improve even more than proportionally, but if they improve proportionally, 142 times an additional 41, this operating income becomes 200, right? It becomes 200 million right there from a back of the napkin. So then Q4 is 200 million. So you improve from last Q4 by another $120 million. Another $120 million improvement on trailing 12-month operating income. And by the way, some more cash in the bank too. So after Q4 comes out, which is what, 5 months away now in March or something, they release those numbers. Let's say you got another 200 million in cash and you've improved your trailing 12 month by another 120 million. Well, now this is 397 trailing 12 month. And now your PE is 6, even though your growth numbers would be even more impressive than the quarter before, which are even more impressive than the quarter before, which are even more impressive than the quarter before and the quarter before and the quarter before, right? They're actually growing, you know? So again, to have a fair PE that you'd say maybe it doesn't deserve to be even higher 50s or 60s, but to get that PE in the 40s after their Q4 number comes out, then you're looking at a 15, 16, right about more like a 17 billion plus the 6.5. So then you're looking at a $23.5 billion valuation in just 2 quarters if you're kind of bearish, you know? So that's why I call this fair value is 26.5 in a floor case, right? I'm showing you guys a bear case scenario. And if we were to do that again for Q1 and Q2 of next year, right, the full 1 year price target, then guess what? This enterprise value plus cash value net of their convertible debt, right, even if you wanted to net out the debt, is going to get you in excess of that 26 billion. And what if they actually do perform? And what if you actually do start looking ahead, right? And then what if you do start valuing their earnings projections year over year as you see that growth come in? Super exciting to think about. Super exciting. Okay, where do we want to end up? That's where we want to be, right there. After Q3 numbers. Boom. If you followed this, let me know. If it was too chicken scratch for you, let me know. Would love to hear your thoughts. How in the world could GameStop possibly be worth less than what they have in cash? This is how. Okay, this is how. We know ultimately the convertibles won't be both debt and dilution, but if you wanted to say it's not dilution, right? We're not valuing dilution at all until GameStop is trading well above the conversion price, and we're not going to project the cash floor rising faster than the conversion price arriving. We're not going to do that, right? We're not going to do this. We're going to get more conservative, just look kind of backwards. What do we know for sure? What's the base case, worst case scenario? Okay, that means convertibles are debt. What does that mean for enterprise value? It means right now you're looking at a 29. And honestly, do I think that's a good buying opportunity? I do. Not financial advice. I do. Because how is that 29 age, right? If this is how you fundamentally justify GameStop trading where it is right now, then what are you going to do when GameStop improves its operating income by almost $300 million, a $300 million improvement in operating income, right? A quadrupling in trailing 12-month operating income that's going to land in the next 2 quarters. If you're a long-time GameStop investor, of course, you are so exacerbated by all these years of short selling and stock price manipulation. But do not lose heart because the reality is, if you want to interpret GameStop's fundamentals from a bearish perspective, it was trading in excess of fundamental value for the vast majority of this period of time. And it's about to not be. It is about to not be. It's finally actually time. The turnaround has finally turned. Oh, how the tables turn. Oh, how the turntables. All right. That's all I got for y'all today. I will see you in the next one.